Let's bring in Treasury Partners CIO, Rich Saperstein. He's here with me at Post 9. He's one of Barron's top-rated financial advisors, so we need your advice, especially right now. Welcome back.
Thank you.
Are you still sitting on a pile of cash?
Yes, we are.
Why? Why are you still so negative in the market?
Well, we're not exactly on cash. All the cash was moved into bonds, as we spoke about last September. But if you look at the facts on the ground right now, you have M2 negative for 6 months.
Money supply.
Right. Consumer spending is down. Availability of credit is tightening. Leading economic indicators that prospectively tell what's going on, they're dropping. So we expect the economy to slow in the second half of the year.
I mean, it's been much more resilient than people have thought. I would assume you included. The consumer, even though retail sales were slowing, they're still pretty good. Employment is pretty good.
Those are the two positives, but Home Depot the report this morning will clearly refute that.
Yeah, but I mean, there were other factors going on in there too. And even if we throw up Home Depot shares, they've come off the mat of where they were. And there were some, other extraneous factors that came to play there too.
But if you look at the first quarter performance, market's up 8%, but the equal weight is flat. So it's really been driven by big tech, which is the largest component of the S&P on a cap-weighted basis. So the tape really isn't trading too well.
This has become the issue of the moment. The top-heavy market, right? The mega caps are pulling the weight of everybody else. So what? So what? Why is that such a big deal?
Well, we're overweight big tech, so that plus our other asset-allocated parts of the portfolio. So we're okay with that. We don't have a problem with big tech pulling the market.
No, but people cite that as one of the reasons to build the bearish case. Oh, breadth is terrible. It's so narrow. So what? Why does that matter so much?
No, we're building a cautious take, not because tech is leading the market, but rather because the fundamentals are deteriorating. We had 15 years of free money, quantitative easing, as well as a $5 trillion fiscal push that we're taking is a big lag to burn that off. So we're wringing out those excesses. Figure second half of the year is when we'll start seeing a slowdown.
You think the Fed's done?
Yeah.
So they're not raising any more?
I don't think so, but keep in mind, there's a lot of conjecture about the resolution of the debt ceiling. The debt ceiling will result in a trifecta of tightening. It'll supercharge QT. Here's how it works. Yellen's been burning down the Treasury General account, the TGA, in not issuing treasuries. Powell's still doing QT, so the offset has been pretty constant if you take away what Powell did for the banking crisis drama. So once the debt ceiling is resolved, which maybe we'll get it, okay, who knows, Yellen's going to have to rebuild her checking account. So it's estimated that she'll be issuing an extra $600 billion worth of treasuries in the second half of the year. That's a tightening. Combine that with QT, and then add that to the banking drama that has resulted in bank willingness to lend decreasing. It's going to be some real tightening in the second half of the year.